Look at this scale. If you keep 100% of your investments inside the Indian domestic market, your portfolio is heavy on one side, exposed to a single economy. To balance the scales, you need to allocate roughly 10 to 15% of your capital globally. This global exposure acts as a vital hedge. If domestic equities face a severe correction, U.S. markets can provide the structural balance needed to keep your overall net worth stable. Beyond equity performance, holding international assets protects you against currency devaluation. Historically, the Indian rupee has steadily lost ground against the U.S. dollar, meaning foreign holdings gain value purely through exchange rates. Allocating capital outside your home country is a necessary step for serious, long-term growth. The question is no longer whether you should do it, but what mechanical route is the most efficient way to actually get it done. Your first option is Route A, Indian International ETFs. You stay right here, using familiar domestic mutual fund houses to buy bundles of global stocks. Your second option is Route B, direct U.S. brokerage accounts. You open a platform that places you directly on the floor of international markets. This flowchart illustrates the core dilemma. To hit your target of U.S. market exposure, you are forced down one of two paths. You have to choose between the domestic tax convenience of Route A and the precise execution control of Route B. Neither system is flawless. The goal isn't to find a perfect method, but to clearly identify which specific compromises you are willing to accept to secure your global allocation. Taking the Indian ETF route inherently limits your investment universe. You are restricted to broad market indexes, typically tracking the NASDAQ 100 or the S&P 500. In practice, this means your hands are tied. You cannot execute specific thematic plays, target niche healthcare sectors, or buy individual shares of a specific tech company you believe in. Direct U.S. accounts remove those guardrails. You gain access to thousands of individual stocks and ETFs. Plus, you gain the ability to buy fractional shares, allowing you to invest in high-priced companies with as little as $1. You also gain a massive execution advantage. Direct brokers allow you to buy and sell during active, highly liquid U.S. market hours, securing exact pricing on your orders. Looking at this comparison matrix, the first row makes the trade-off clear. ETFs offer a simple, curated basket, but if you want active choice and precise execution, direct accounts win outright. The convenience of Indian ETFs comes with invisible financial drag. These domestic ETFs rarely trade at their actual net asset value. Instead, their price is dictated by local Indian buyer and seller demand. This chart tracks the problem. Underlying assets follow a stable baseline, but local illiquidity forces the trading price to spike violently. The red gap represents a liquidity premium. The second you purchase the ETF, you suffer an immediate hidden loss. Then comes the regulatory hurdle. SEBI strictly limits Indian mutual fund houses to a total of $7 billion for overseas investment. Because this industry-wide limit is frequently breached, fund houses are periodically forced to freeze and reject all fresh investments into their international funds. These sudden freezes destroy your ability to maintain a disciplined monthly SIP strategy. Direct U.S. accounts bypass the SEBI cap entirely. Instead of relying on a shared fund limit, you utilize your individual liberalized remittance scheme quota, which allows up to $250,000 per year. The only friction point with the LRS route is the flat transfer fee. If you're remitting very small amounts, like deposits under $100, you might pay a flat $1 charge, which eats into your margins.
Pulling our matrix back up, row 2 shows the stark contrast. The seemingly easy ETF route subjects you to structural premiums and hard freezes, whereas direct accounts offer high capacity with only minor upfront fees. The single biggest argument for Indian ETFs is total tax convenience. There is zero upfront tax collected at source, and you simply pay standard domestic equity taxes when you eventually sell. Direct U.S. accounts require administrative effort. You have to navigate TCS rules, tracking whether your yearly outward remittances have crossed the 1 lakh or 7 lakh thresholds. This flowchart illustrates the dividend problem. If a U.S. company pays you a $100 dividend, the U.S. government immediately cuts away 25% at the source, leaving you with just $75. The danger is double taxation. The Indian government still views your income as the full $100, and expects you to pay standard income tax on that original amount. To fix this, you have to file a foreign tax credit under the Double Taxation Avoidance Agreement during your annual ITR process. Filing this credit properly offsets the taxes you already paid to the U.S., dropping your Indian tax burden down to a minimal differential. But it requires you to actively do the paperwork. For capital gains on direct U.S. holdings, the rules are straightforward. If you hold the assets for more than 24 months, you pay a flat 12.5% tax. On the final row of our matrix, the trade is clear. ETFs give you absolute peace of mind at tax time. Direct accounts reward you with exact pricing, but only if you are willing to manage the administrative friction of DTAA filings. When you buy an Indian ETF, your returns are calculated and paid out entirely in Indian rupees, masking the underlying currency dynamics. With a direct brokerage account, your capital is physically converted and held in US dollars. In 2003, $1 US cost roughly 46 rupees. Today, it costs significantly more. The rupee has faced steady, historical depreciation. Because of this math, even if a US stock experiences zero growth over a decade, you still generate a significant profit simply by converting those held dollars back into depreciated rupees. Utilizing a direct US brokerage account serves as a built-in systemic hedge against domestic currency inflation, functioning alongside the performance of the underlying stocks. This quadrant chart cuts through the complexity. The right choice depends entirely on your need for control versus your tolerance for paperwork. Let's define the first persona, the beginner who is short on time, dreading complex tax filings, prioritizing convenience. This investor lands squarely in the Indian ETF zone. You accept hidden premiums and SEBI freeze risks for a stress-free process. Then we have the optimizers. You want fractional shares, precise live market pricing, and direct dollar exposure. This profile moves straight into the direct US brokerage zone. You capture peak efficiency, provided you accept the responsibility of DTAA tax filing. There is no universally perfect route. Success comes entirely from choosing the system that matches the amount of administrative effort you are actually willing to exert. Finally, look at this trend. You might see the market hit an all-time high, assume a crash is imminent, and decide to wait. Attempting to time global markets is a mathematical trap. Consistent, disciplined cost averaging will always outperform waiting for the perfect dip that may never arrive. Whether you leverage the tax convenience of domestic ETFs or the exact execution of direct brokers, the absolute best time to start building your global allocation is right now.